Today, folks, dividend stocks are absolutely tanking right now. And I want to break down the scenario that's causing this because there's huge opportunity in this sector of the market. As many of you know, I've been loading up on Canadian banks, a lot of Canadian dividend pairs, but in the US, there's huge opportunity with some of these ETFs I hold, like SCHD, and a lot of the components in there have absolutely tanked over the last month. We're going to talk about some individual dividend stocks like Enbridge, some of the healthcare companies like J&J and Pepsi, and so much more in this video. So consider hitting that like button as we try and figure out a appropriate strategy to kind of take advantage of some of this, because I mean, take a look at the comparables against the S&P 500, and typically these dividend ETFs have actually kept up with the performance, some of which over the last 5 years were outperforming the S&P 500 as of up till recently, right? I mean, take a look. So the S&P 500, and let's not even talk about the NASDAQ, it's been tech that has come back with an utter vengeance basically since the beginning of the year. But when you look at things like VDY, one of my favorite Canadian monthly paying dividend ETFs, the Schwab US Dividend Equity ETF, DGRO, the iShares Core Dividend Growth ETF, which has been arguably one of the better performers because it does component things like Apple in there. And then VYM, outside of DGRO, it's been a pretty bad hellscape for most of us dividend investors. But again, I'm arguing this is a potential buying opportunity. This is where you get to fast track your retirement. So the value metrics that have set up here are pretty intriguing because you look at things like DGRO with a PE multiple of 17 right now. I mean, VYM here sits at about a 14.5 PE. SCHD sitting at about a 13 PE, and I dare I even ask, what is VDY sitting at? Because the Canadian markets I think are trading at some of the most favorable multiples of a 10 PE on average right now. So why are these dividend ETFs, these dividend stocks getting absolutely hammered? Well, obviously a lot of this has to do with interest rates. As interest rates have peaked over 5%, it leads to this intriguing contemplation of, do I want the risk of owning a volatile stock in a macro environment that could lead into a recession? Yeah, the yields are, some of them, well over 5%, but man, when you can get crazy money off GICs and bonds, which we'll take a look at, but the interest rate policies right now in Canada, which is a defining factor for typically what happens in the US, they're maintaining the current base rate, which I think is what, 5.25, generally where we're sitting. So they're not raising the rates anymore, and they kind of give you the same spiel they always do. They're like, oh, if we have to raise them again, we'll raise them again. But they're saying economic growth has slowed sharply in the second quarter of 2023, with output contracting by 0.2%. If we get another consecutive quarter, it's a technical recession at an annualized rate. Now, this reflect a market weakening in consumption growth and a decline in housing activity, as well as the impact of wildfires in many regions of the country. Household credit growth slowed as the impact of higher rates restrained spending among a wider range of borrowers. Now, my bull thesis on the market is this is inevitably going to come to an end. I keep getting all these bears and these critics saying, oh, they're never going to bring interest rates down. And I'm pretty confident that by next spring to summer, we get 2 consecutive quarters of nominal inflation, that they will start cutting rates. And that's when all of a sudden, GICs and bonds, and all of a sudden those things become less appealing. And something tells me they would cut rates generally to keep it in line with the inflation numbers. So if inflation's holding between 2 and 3%, I wouldn't be surprised if interest rates come back down to a nominal 3% rate. Now, that's just me speculating, but take a look at these GIC rates. These are guaranteed investment certificates here in Canada. And on a 1 year right now, you can get over 5%, 2 year 5.2 with Royal Bank. Toronto Dominion's offering an 18-month special here at 5.15. CIBC is going to give you a 1 year at 5.1. Even Scotiabank here is offering a 2 year at 5.6, which is probably one of the highest I've seen. So people are going to continue to flock to these, and probably clearly tech companies. It's where all the attention is, but obviously tech is probably getting to a place where potentially it's going to be overbought. That's where all the investor money's been going, outside of cash, apparently. So the plan here for me, and what I've been doing, is implementing kind of this dividend strategy, and I want to talk about a few different ways to go about it and how you can kind of optimize your portfolio without taking on too much excessive risk, because right now individual company risk is higher than it's ever been. We look at a company like Enbridge that year to date is down 14% at a time where the NASDAQ since the lows is up like 40 or 50% since last October. But it's been pretty abysmal for Enbridge here, which is currently yielding a whopping 7.8%. I was in the forums. People are absolutely hating on this company, and I don't think it's that just, because recently They raised, I believe, about $4 billion in some underwritings from some banks to purchase a natural gas utility franchise in North America. But this creates North America's largest natural gas utility platform. I don't think people understand like how much this defines already the largest pipeline company in North America, but they are expanding into this highly valued area of natural gas, which is going to be a proponent of the renewable future, right? And the question is here, how much value can this honestly add to the company? Because historical attractive acquisition multiples based on 2024 estimates of 1.3 times the enterprise value to rate base, and 2023 estimates of about 16.5 times price to earnings. So it seems like, these guys are experienced, they understand the industry, and they're buying it in a time where, oil has been kind of suppressed a bit, but this seems like a pretty reasonable acquisition for them. But again, they had to dilute shareholders to do so, and people are taking this extremely negatively. And for being Canada's third largest company, I mean, just seeing these drops is profound. It's not like the US where Apple, Amazon, Nvidia, these stocks are flying. In Canada, all our mega cap companies pay huge yields, and now they're paying like 10, 20-year historically high yields. I mean, Enbridge right now is paying out what's the exact yield as of today? 7.8%. The last time Enbridge paid 7.8% was basically during the pandemic, where it just touched 8%. And again, you go all the way back through their history and they've never yielded this high of a dividend, right? Look at Pepsi. Let's look at some of these US stocks. Pepsi's been a favorite of mine. I'm glad it's a fairly large proponent in things like SCHD, a lot of these dividend ETFs, and this thing has even been trading down to the negative now on the year to date. It's down 10% from the recent highs over the last year. And I mean, it's almost yielding 3%. And again, in history here, if we get back up to 3%, anytime Pepsi's yielded over 3%, and it usually doesn't get much higher than about 3 to 3.3, it's always been a buying opportunity, because typically it seems to trend on average between 2.7 to 2.8-ish, give or take. So you're just seeing a lot of opportunity. Coca-Cola has been getting crushed here. Again, you zoom out, it's not doing as bad, but just year to date, in comparing it to these big mega cap tech companies, it's kind of astounding. People have just started to write these things off. Look at Johnson & Johnson here. This thing's down almost 11% year to date. I mean, the yield on it, again, what's Johnson & Johnson paying right now? 3% dead on. Johnson & Johnson's 3% yield is something we really haven't seen since when? Since 2015, and then you'd have to go all the way back to 2012 before you were paying those high of yields. This is a once-in-a-decade opportunity for those of you that are looking to cash flow and fast-track retirement. This is stuff I love. I mean, look at Pfizer. Ever since the pandemic, completely written off. This thing's down 32% year-to-date. Yes, their cash flows are dropping pretty dramatically. I think they only generated, like $12 billion in revenue for the last quarter, which was down, I think, 40 or 50%. These companies are always going to come back around at some point. I mean, Pfizer is just one of these mega cap pharmaceutical companies that was the darling child of the pandemic, paying 4.77%. Is that sustainable? I'm sure there's going to be companies that get scathed through this. We're already seeing dividend cuts, but some of these are gems. In a lot of these, even if they cut the dividend, I mean, the yields are so damn high, they could cut them by half and you'd still be getting some pretty historical high yields. Because, I mean, outside of the pandemic, I mean, Pfizer's never really paid these kind of yields outside of the 2008 financial crisis. I'm loving the telecom sector. Again, a huge proponent of SCHD with Verizon. I mean, you take a look at this thing, and again, people have written it off. They're just done with these companies, and it's yielding 7.6%. I mean, again, a historical high at this point for Verizon. You can't go back outside of the 2008 crisis again without getting these kind of yields. And I love the Canadian components here, like TELUS, the counterparts here on the Canadian side of the border. This thing's yielding 6.2%. I think it's just absolutely astounding. So what could be a strategy here? What could work for somebody who's looking to take advantage of this? Because right now I think tech has largely been overbought, but I kind of come back to my 4-fund strategy here, which basically just concludes for me that I would like to basically pick 2 dividend ETFs. I like VDY. I do like the Schwab US Dividend Equity ETF, and then kind of pair that with something like the S&P 500's VOO, and you should also get some growth in there like QQQ. Now, in my portfolio, I do speculate on individual stocks. I speculate on some small caps. I'm still looking at buying some small caps, but I think for most people, and the vast majority of my retirement portfolio will base on that 4-fund strategy. So some growth with QQQ, broad market S&P 500, and then 2 dividend ETFs being VDY and SCHD for me personally. And when the market goes into these kind of cyclical trends between these sectors, when growth is exploding to the levels we're seeing, I mean, you pop QQQ in here and let's just take a look, because it's crazy, right? So I mean, I think it'd be good to get a proponent of growth. You shouldn't give up on growth by any metric. So get QQQ in there, and when growth starts to over excel into the market, cut back on how much you contribute to that fund and take that pillar down a bit, and then start increasing the contributions to the other pillars like these other dividend ETFs. I really feel as though you could potentially make about a 4 or 5 multi-pillar ETF strategy in these different sectors of the market, and just play them and distribute your capital depending on what ones are more suppressed. I think it's probably the best option for most people. I know people that have, emergency funds just for when the market crashes. So as the market dips, say 5-10%, they start increasing the monthly allocation for as long as it stays down at certain percentage points. There's a lot of fun ways to play this, but at the end of the day, it's all cost averaging into these when it makes sense, right? And always just be buying. And that's kind of where I'm currently sitting, but I'd love to know what you guys think in that comment section below.